Hey there, Visualeconomik viewers. It seems that once again, the news, the global economy, and banking are threatening us with a new crisis like the one in 2008.
The collapse of Silicon Valley Bank raises fears of new financial crisis.
The financial sector is on high alert. Today is more important than ever to know what is happening, what happened to Silicon Valley Bank, where we are heading, and of course, who exactly is to blame for these new banking tremors. That is precisely why here on Visualeconomik, we are going to launch a series of videos talking about the situation of both European and North American banks. We will talk about exactly what happened with Silicon Valley Bank. We will tell you why the regulations were not able to stop the fall of this bank, and as if that were not enough, we will also explain the risk of situations like this spreading to more major banks. Are you ready? If so, let's get started. If we had to identify a starting point for the story of the Silicon Valley Bank collapse, that point would be the spring of 2020. At that time, most governments around the world were very frightened due to the emergence of the coronavirus. The pandemic had just arrived, and no one knew exactly how that would affect the economic situation. Faced with this problem, let's just say that some governments got a bit nervous and began to adopt political measures as if there were no tomorrow to try to avoid possible economic damage. Well, it turns out that one of those knee-jerk policies was the stimulus packages in the US. Basically, these packages consisted of first Donald Trump's administration and then Joe Biden's administration handing out lots and lots of cash to US businesses and citizens. From that moment on, the volume of savings in the US skyrocketed. Specifically, it is estimated that Americans, in just 1 year, accumulated excess savings equivalent to more than $2 trillion with a T. And of course, that money could not stay floating in the air. It had to be put somewhere, and that place was the banks. US banks began to see their deposit levels increase by leaps and bounds. Banks were getting their hands on more and more money via bank accounts that were at their full disposal. But also, throughout the story, there was one specific bank that got more money than anyone else. Of course, we're talking about Silicon Valley Bank. To give you an idea, this bank multiplied its deposit volume by more than 3 times, more than double the average increase noted by other North American banks. More specifically, while the Silicon Valley Bank had only about $60 billion at its disposal before the pandemic began, after it, this pot had increased to $200 billion. A real folly, a full-fledged expansion. The question is, why did this bank grow so rapidly, much faster than the others? Why did everyone start giving their money to Silicon Valley Bank? Well, the short answer is because this bank became fashionable among North American technology startups. Typically, it offered loans on good terms to these companies in exchange for them depositing their savings there and working with them. But also, in general, 2020 and 2021 were very, very good years for technology companies. Something that can be seen by observing the stock market performance of giants such as Google and Alphabet during those years. And of course, if the bank's main clients earned more money, then the bank also increased the money it had in its hands. A win-win situation for everyone. However, in this whole story, there was one serious problem. You see, normally, when conventional banks have a lot of money, they can lend it to families and companies through mortgages, credit cards, or personal loans. However, Silicon Valley Bank was not a bank used to working with families or conventional companies. Instead, it was dedicated exclusively to lending to technology startups. So what was the problem? The problem is that this bank had managed to raise so much, and we're talking a ton of money, that there were practically no technology companies left to lend their money to. And yes, I know what you're thinking. Couldn't they have just left the money alone without lending it to anyone? Well, yes, they could have done that, but it would have caused them to actually lose money. At the end of the day, the business of banks is basically to take money from their customers and invest it in loans or assets such as stocks or treasury bonds. Normally, customers receive a percentage of interest on their deposits, and the bank receives another type of interest on its investments. The difference between the interest the bank receives on investments and the interest it pays to depositors is known as the spread. If the spread is positive, the bank makes money. If the spread is negative, then the bank loses money. Well, understand that if Silicon Valley Bank had left its money in place without investing it anywhere, it would not have been able to have a positive spread and therefore would have actually lost money. So in order to solve this, they came up with a strategy. Invest in mortgage bundles and to a lesser extent in debt bonds. To keep it simple and to skip complexities that we will explain in a future video, these bundles of mortgages and bonds are what you may have seen in the news dubbed as HTMs. So what was the advantage of investing in these types of assets, in these HTMs? Well, they gave the bank a fixed interest rate, fast, secure, and lasting over time. give you an idea, back in 2021, the HTMs gave a yield of about 1.63% fixed interest, while the interest on deposits was only at around 0.13%. Or to put it another way, the bank was earning almost 1.5% spread without doing anything at all. Overnight, Silicon Valley Bank had the formula for free money. So what do you think it did? It invested more and more in these types of assets. Basically, the bank was up to its ears with more than $90 billion worth of mortgages and government bonds. In fact, it went so far as to buy another entire bank dedicated to real estate to further increase this type of investment.
SVB Financial to buy Boston Private for $900 million.
In short, everything was going smoothly among the Silicon Valley tycoons. Nothing better than a good, fixed, long-term spread to line their pockets, or at least for a while. As you may already know, between late 2021 and early 2022, inflation hit the West, and with it, the notorious interest rate hikes. As a result, let's just say that things started to get very ugly at the Silicon Valley Bank. It turns out that their main clients, technology companies, began to have a lot of problems raising financing. These companies typically depend on private investors to pay salaries, invest in research, and develop new projects. So, what's the problem? Well, when interest rates rise, investors stop investing in these technology companies in favor of investing in other investments with better risk returns, such as treasury bonds. In other words, these companies ran out of money. Something that, as you can see in this graph, happened in mid-2022, just when interest rates skyrocketed. Well, as companies lost the backing from private investors, they had to withdraw the savings they had in the bank to be able to pay salaries, suppliers, and taxes. And they all did it at the same time. In addition, as interest rates rose, other competing banks began to offer higher yields on deposits, causing Silicon Valley Bank to lose clients and, of course, even more money. In short, you could say that almost overnight, deposits at the bank began to fall. Silicon Valley Bank was losing more and more customers, and naturally, that was something it could not afford. The question is, why not? Why couldn't the bank afford to lose its customers? Well, because, as we explained earlier, most of the money that customers had in the bank was invested in assets, such as very long-term mortgage packages. In other words, the bank did not have its clients' money at its disposal, and if a lot of them left at once, it simply would not have the money at its disposal to return it to them. Perhaps one solution could have been to sell these mortgage bundles, convert them into cash, and thus be able to meet customer requests. However, there was another problem here. The mortgage and long-term investment packages held by the Silicon Valley Bank had a fixed interest rate of 1.72%. That interest rate had lagged far behind. It was very low. For example, after the interest rate hike, the new government bonds were paying 3.62% in December 2022. In other words, this means that if Silicon Valley Bank wanted to sell its little bundles to raise money, no one was going to buy them. They were bundles that gave very little return, and therefore, no one wanted them. The only alternative would have been to sell them at a discount for much less money. The problem is that if the bank had sold these bonds at a discount, it would not have had enough money to pay back all of its customers. So there was only one alternative left. If the Silicon Valley Bank wanted to survive, it had to prevent its customers from withdrawing money from the bank. And how could it do that? Well, by raising the profitability of deposits. And guess what? No sooner said than done. Suddenly, it started paying much higher interest rates to its customers so that they would not withdraw their money. The question is, did this mechanism work? Well, in the short term, we could say yes, but in the long term, there was another problem. The interest paid to customers on their deposits had to be increased so much that it exceeded the interest received on long-term investments. In other words, the bank began to have a negative spread and thus began to lose money on these investments. And the worst part of it? The worst was yet to come. Interest rates would continue to rise. Losses would increasingly erode the bank's financial capacity, and the situation would become totally unsustainable. However, this was far from the end of the story. The bank's managers were really smart and came up with a super master plan to solve the problem. Listen up. Let's recap. The Silicon Valley Bank needed to offer its clients attractive rates so that they would not take their money elsewhere. It also needed to recover the positive spread somehow, but at the same time, it could not easily get rid of its investments that yielded very low interest rates. What could be a solution to fix this whole mess? The solution the managers came up with involved two key moves. On the one hand, they decided to sell a portion of their investment packages to the market, specifically to the tune of about $21 billion. This would allow them to do two things. The first was to reinvest the money from the sale into buying assets that yielded higher interest rates so that they could solve the spread problem, but the second is that with that money, they could increase the liquidity cushion in case things got worse. It was a good old 2-for-1 deal. However, as we have said, selling these packages meant selling them at a discount since they gave very little return. So with the sale, the bank would have to book a loss of $1.8 billion. These losses could not be tolerated in regulatory terms. The bank had to compensate for them in some way, and that is where the second crucial move came in, the capital increase. The capital increase basically consisted of asking for more money from the owners or potential owners of the bank. In other words, they asked for extra disbursements from the shareholders. Specifically, the bank proposed a capital increase of $2 billion. And the truth is that, on paper, this was a very good idea. $2 billion served to compensate for the previous loss of $1.8 billion and would provide an even larger financial cushion. In fact, at this point, the bank's situation was not all bad. With that capital increase, it could have gone ahead with far fewer problems and even started earning money again. However, that was not the case. There was one thing that had to happen for the bank to finally head for disaster, something that caused this restructuring plan to fail completely. In theory, a capital increase could be a good idea for solving your problems, but in practice, it can be your doom. Asking for a capital increase is like turning on a loudspeaker and shouting to the whole world that you have problems. And that, in the world of banking, is real danger. Basically, because if your customers realize that they are at risk of not getting their money back, they will all go en masse to take their money out, even if the risk is low, even if the risk is completely unfounded. Well, that is just what happened in Silicon Valley on Thursday, 9th of March 2023. And following the warning that came with the capital increase, several tycoons in the tech world started spreading panic and telling everyone to get their money out of the bank.
Peter Thiel's Founders Fund advises companies to withdraw money from SVB.
As a result, customers began to realize that the Silicon Valley Bank could be in danger. And it is true that in case of default, there is an insurance that covers up to a limit of $250,000 for each account. However, at Silicon Valley Bank, more than 90% of the clients were companies with money that far exceeded that limit. Money that was not covered by insurance and would be lost in the event of bankruptcy. This is precisely why customers decided to take their money out of the bank in a mad rush, and then absolute panic set in. In addition, other banks such as JP Morgan seized the opportunity and started making robocalls to convince customers to withdraw their money from the Silicon Valley Bank because the competition is just ever so friendly.
JPM bankers pull all-nighters to take on clients of Silicon Valley Bank.
The result of all this chaos and banking panic was that in just one night, Silicon Valley Bank customers withdrew a whopping $40 billion. That is nearly 25% of the bank's entire assets, a completely unaffordable figure, which forced the authorities to intervene and declare insolvency. On the 10th of March 2023, just one day after panic swept through Silicon Valley, US banking authorities took control of the bank. Since then, several announcements have been made. The first is that no depositor, no company, will lose its savings. The second is that the Federal Reserve will open new avenues of liquidity to prevent the panic from spreading to other banks. And the third is that the shareholders and bondholders of the Silicon Valley Bank will lose all their rights. We will talk about the consequences and details of these three things in a future video. However, in this one, there is still one question to be answered. Now that the bank is under the control of the authorities, what will happen in the coming weeks? Ideally, a larger bank would buy Silicon Valley Bank and take over its debts and deposits. In fact, this is likely something that has already happened by the time this video is uploaded, which is later than when the script is written. And without going any further, the UK branch has already been bought by HSBC.
HSBC pays £1 to rescue UK arm of Silicon Valley Bank.
If the purchase by a larger bank ultimately does not take place, what will happen is that the authorities will sell all of the bank's assets, distribute them among customers, and if money is missing, a special bank tax will be created to cover the additional costs. A tax that, by the way, could end up being passed on to its customers. That is, ordinary citizens. So that's where things stand. It should be noted that in today's video, we have left out many details along the way. Details that, of course, we will delve into in upcoming videos. Here, we simply wanted to explain the events that have caused the failure of this bank. So now, it's your turn. What do you think of the bankruptcy story? Do you think it could have been avoidable? Do you think the banks should be bailed out, as the US government is likely to do? You can leave me your answers in the comments. If you like this video, like it, subscribe so you don't miss any of the upcoming ones, and we will see you in the next one. See you very soon. Thanks for being here.